I will never pay extra in my bond to pay it off sooner. Why would I pay off cheap debt when I can put it to work? And home financing in South Africa is one of the cheapest forms of debt that you can get. Now, you're probably thinking that, hey, shouldn't I pay down my bond and eliminate that debt so that I can be financially free sooner? I would say it's better to invest that money so that money can grow exponentially. Let's take a deep dive into the pros and cons of both these options, and then you can see for yourself so that you can make the right choice, because that means the difference between millions of rands or a couple of 100,000. Hi, my name is Yolanda. I'm a wealth advisor, and it is my goal on this platform to give you easy, actionable tips, content, and strategies that you can use to manage money well, to live abundantly and build generational wealth. Now, I am a fit and proper South African financial advisor, and although I'm a proper financial advisor, the content that you're about to watch or listen to does not constitute financial advice. In fact, anything that you see of mine online is never financial advice. Financial advice is when you sit with a qualified advisor who will give you advice based on your personal circumstance. So if you find anything that I say in this video interesting, go and speak to your financial advisor about it. Or if you don't have a financial advisor, click the link where you're watching this video and I'll be happy to sit with you one-on-one and give you proper financial advice. Now, before you decide on whether you should be paying down your home loan debt or should you be investing that extra, you got to make sure that you first establish your financial foundation. I have an entire course dedicated to teaching you how to establish your financial foundation. Click the link below where you're watching this video and maybe even DM me on Instagram. I might have a coupon code available for you where you can get that course at a discount. But click the link where you're watching this video and you can purchase the Financial Foundations course. So building a financial foundation means getting rid of your high interest debt, building up an emergency fund, securing your estate, planning for your retirement, getting your financial affairs in order. But where do you start? And that's what that course is all about. For example, if you get sick, if you don't have an emergency fund to take you through that period of downtime, what's the point in investing? Maybe your investment hasn't reached its peak yet. Maybe you would be forced to withdraw that investment at the loss to fund your ailment and your downtime when you are sick. Putting that financial foundation in place allows for you to be secure no matter what life might throw at you. So before you even start investing, make sure your financial foundation is strong. Now, when it comes to debt, the more debt you have, the more high interest debt you have, the more likely you are to be living hand to mouth, because most of your income is going towards paying that high interest debt. And maybe it feels like you're going to work every single day, and as soon as payday comes, those debit orders just fly off your account. And that's a horrible place to be in, knowing that you got to work another 30 days for the exact same thing to happen until you clear up that high interest debt. And maybe while you're doing this, the balance of your debt is slowly going down. But a large percentage of your monthly payments goes towards the interest portion of the debt. And eventually, after a couple of years, depending on how much of debt you have, once that debt is paid off, it feels like a huge chip has been lifted off your shoulder. It's like you have a huge raise now because you have so much more of this free income or greater amount of discretionary income that you can use to invest and grow your wealth even further. For example, you may use these extra funds to start contributing to your retirement savings. Maybe this would allow you to retire earlier than 55, because in South Africa, that's the minimum age at which you can officially access your retirement products. And notice I said retirement savings, not necessarily retirement annuities or retirement products. And if you're a client of mine, you'd know why I said that. Alternatively, which is my choice, I choose to deploy my extra funds into investments or expanding my business, something that will grow my money even further, greater than the rate that I am paying for my home loan. So aim to be debt-free. So I aim to be debt-free. Debt-free in terms of high interest debt gone, but leveraging the low interest or the low debt of my home loan. The reason for this is that the return from my potential investments could give me a higher return than the actual debt that I'm paying to borrow this money. It could end up making me a lot more money, sometimes even tax-free money as well. Does it really make sense to pay down an 8% interest rate when you possibly could be growing at 12, 13% somewhere else. Now, we also need to remember the Fisher equation here. And we spoke about the Fisher equation before. Now, according to the Fisher equation, you have to take into account the impact of inflation in paying off your debt and your investment return. To deploy this Fisher equation, you got to subtract your debt from the inflation rate. So at the time of recording this video, inflation is at 6.5. Maybe your home loan debt is at 8.5. So 6.5 minus 8.5 is giving you 2. So 2%. That's literally your rate of borrowing on your home loan, if those are the rates that's applicable to you. So try this on your bond or your home loan. So let me know in the comments, what is your rate of borrowing after you deploy the Fisher equation? The thing is, becoming officially debt-free in terms of home loans, it could take you years, possibly even decades to make that happen, causing you to lose out on large amounts of compound interest that you could be enjoying the earlier it is you get in the market. The biggest factor when it comes to deciding whether to aggressively pay down your home loan or not is risk. When you pay down your debt, you're essentially getting a guaranteed return. For example, let's say your credit card or your personal loan is at 30% interest. That is the rate of lending that the bank gave you. If you pay down your credit card at 30%, you're basically guaranteeing yourself a 30% return with zero risk. And that's the value of paying down high interest debt. Investing is always going to come about with some sort of risk, unless you're in a guaranteed investment, and those returns are super low. Now, you're probably thinking, is it really possible for you to earn 10% or more when it comes to investments? And yes, you can. For example, the S&P 500. People began tracking that for almost 100 years already. And on average, during that time, the S&P 500 returned around 10% or more. Now, given there were some years where there was a -10, a -5, a -20, but over the long term, the S&P 500 has averaged over 10%. And this is the current state of the S&P. So I don't know what you see in this picture, but I see potential, I see a sale. From that, you can guess what my behavior is going to be. Now, over the long term, the odds are in your favor that you are going to get a positive return from the markets. Now, these returns are never guaranteed, so it's important to factor that into your financial plan. Let's take a look at a real life example of how this is going to work. So let's take a deep dive into these options. So let's say we buy a property for 2 million with an 8% lending rate on that. That brings our monthly payments to 16,728 rands over 20 years. And let's say we choose to pay an extra 4,000 rand into that bond to try and save up on some interest and reduce our repayment period. So if we do that, we manage to pay off this bond in 12 years and 11 months, making our total repayment 3.2 million rand some change. Now then you have the option 2. Okay, with option 2, same scenario, but instead of making those additional payments, you invest those payments. All right. And eventually over 20 years, you settle this bond and you've paid a total of just over 4 million rand for a 2 million rand property. So when it comes to option 1, you settle your bond early, and for that period of seven years until that 20-year period is up on the bond, you take that same 20,728 that you were committing to bond payments and you invest that into an investment that gives you a 10% return. So after the 7 years, you are estimated to get back around 2.4 million some change. However, when it comes to option 2, where you don't pay extra and you invest from the very beginning your 4,000 rand a month into an investment, giving you a 10% return per annum average, your return over 20 years is going to be 2.8 million some change. All right, it's not as straightforward as that. Remember, with option 2, you did pay about 800,000 rand more in interest. And when it comes to investments, you did make about 450,000 or 400,000 more, some change. Okay, but there's some things that numbers can't really reflect on an Excel sheet. For example, these calculations don't consider investment risk. Okay, the markets are unpredictable. Maybe one year you're getting a 20%, next year you're getting a -5. Those are the kind of things that can happen with investments. And if you want to take the risk of not paying down your bond, you're free to do so, but you must understand that investment risk. It also doesn't take into account income instability. And I think that's a fear a lot of employees, well, everybody has in South Africa. With the state of the economy and the way things are going, people would rather just have the peace of mind of just paying the little bit extra and settling the bond as soon as they can. It doesn't take into account investment risk. For example, to get a 10% return, you must be willing to take some risk as well. And also financial peace. I mean, I don't think you can put a price on financial peace. Like I said, some people just want this debt off their heads and doing whatever it takes to pay down their bond. It also doesn't cover inflation, and we're going to cover that in a little while. And it doesn't take into account the personal discipline and the consistency that you need to put down 4,000 Rand a month every month for 20 years into an investment. Okay, so those are the intangible things, but what I want you to consider is, imagine if you had put from the beginning this 4,000 Rand a month into a product like an RA. An RA would reduce your tax liability. It will also give you some decent rebates in the next tax period. For example, if you are somebody that is earning 700,000 Rand a year, a 48,000 Rand contribution into an RA can easily give you back 20 to 30,000 Rand. Okay, and those are the kind of things that you need to be strategizing about when it comes to taking a decision such as this. So here is, I call it a thing of beauty, but if you understand inflation, if you understand how taxes work, this will make a lot of sense to you. It tells you the impact of inflation on your bond payments. Now, instead of me doing some assumptions and projections for 20 years from now, I took a house price from the year 2000 of 287,000 Rand, some change. That was the average house price at the time. But remember, right, we South Africa, we live in a very polarized country. Half our population is living in poverty. Okay, so it's hard to really depict an average home price, home cost, and all of that here. You have to work by suburb. What's reflective in my market where I live is not the same where you live. So you got to find a property that's applicable to you and find the trends in your area. So I did this calculation for a property for about 287,000 purchased in the year 2000. And I listed this is the actual inflation rates for the past, since 2000 in South Africa. All right. And based on that property value over a 20-year borrowing period, this would leave us with a monthly bond payment of 4,220 Rands a month. Okay, so that's what you would have paid in year one. But in the year 2001, inflation was at 5.7. Now we've got to adjust the Rand for the impact of this inflation. So the Rand is now worth 95 cents as compared to the year before. So we got to adjust this value of your bond repayment. Now your bond repayment every month in terms of value is 4,009 Rand. Okay, and if we fast forward this, let's say to 2010, the year of the World Cup, inflation was at around 4%. But look at how the Rand had devalued the decade before. The Rand is now worth 60 cents from when we first started in the year 2000. You're still paying your 4,220 Rands on your bond repayments, but the nominal value that you're paying is now worth around 2,500 Rand. Okay, and this is a big deal. If you really sit down and do these numbers, it's a really big deal. In the year 2020, the year that you would have settled the bond, inflation, we know, was at 3.2, worldwide lockdown. The Rand is now valued at 37 cents as compared to the year 2000. You're still paying your 4,220 Rand a month, but the actual value of that is now 1,561 Rand. Okay, and we did speak about the Fisher equation early on in this video, and here is the Fisher equation applied. You can see in the year 2000, 11.3%. Okay, when we minus prime was at 17 from inflation. The Fisher equation in 2020 was 3.8. 3.8% lending rate. But what if this was an investment property? Investment property does enjoy some tax benefits in South Africa. So let's say in the year 2000, you put some tenants in this property, you charge them 4,000 Rand a month rental. Now, obviously, 4,000 Rand a month is a little less than what you owe the bank. You still have to consider your rates, your levies, if this is a sectional title property as well. So you're not cash flowing at this point as a property investor. Cash flow is important to you. But let's look 10 years down the line in 2010. Let's assume that you had a really good tenant here and you wanted to retain this tenant. Your rental increases wasn't a lot, just 3% a year. So 3% a year would leave you with a monthly rental of 5,372. You're still paying 4,220 Rand a month to the bank. And remember, when it comes to rental income in South Africa on your investment properties, that interest is tax deductible. Okay, so in the year 2000, maybe on your 4,200 Rand payment to the bank, 3,800 was on the interest, and that 500 or so was the actual principal. That interest portion is tax deductible. In the year 2000, you're still paying your 4,220. The rental has appreciated over time. Now you're charging this tenant 7,250 Rand. You're cash flowing 86,000 Rand, some change a month. The point I'm trying to make here is that you got to sit down and do these calculations for yourself. You got to take into account the level of inflation in your investments, and a lot of people are not considering that. And also taxes. Okay, so it's important to do the maths, and it's important for you to understand these sort of concepts. So a very popular thing that's happening in South Africa now is that the banks are giving you 30-year loan periods. And from this, what I just showed you, you can see the benefit of a 30-year loan period, especially if you're into investment property. The home loan payment remains the same over the period of 30 years, but remember that with the impact of inflation, the Rand loses value over time. That means you're able to pay back this loan with Rands that are worth less than when you first started. If inflation is at 7% in South Africa, the Rand will halve its value every 10 years or so. Simply put, after every 10 years, your home loan payment will be worth half of what it originally was, while you're paying it back with the Rands that is worth less than what it was. You can also invest in assets that keep up or even exceed the rate of inflation. With that option, you enjoy the best of both worlds. Now, a home loan is a very extreme example of this. Factor in inflation and getting back that return. In South Africa, home loans are one of the cheapest forms of debt that you can get. It's the closest to inflation that you can get, as opposed to a credit card. Let's say a credit card, 15-20% interest. Inflation is sitting at around 6.5% at the time of recording this video. The closer that the interest rate and the inflation rate is, it means you are basically borrowing money for next to nothing. Second reason is that home loans that stretch on for decades, 20, 30 years, when the difference is that long, and if you do an analysis like I just showed you, the returns can be in the negative, which means you're basically being paid to borrow at this point. But again, it has to be, the analysis must be for that specific property, and we know in South Africa how the various sectors operate. Okay, so there's a couple of things that you need to consider when you do consider paying down your debt. Firstly, it's cash flow, especially for older investors. You are looking for cash flow. Long-term appreciation is not really your thing. For example, 20, 30 years, you need and want your cash flow at this point in time. Risk is another important consideration, considering the environment that we are in now. Can you manage the kind of high-risk environment in terms of investment returns? These are all the things that you need to consider when you are structuring your property investments. Generally, when you pay off a high-interest loan with a low-interest loan, you are most likely able to see positive returns in the long term. But you need to be able to do that analysis for yourself. Also consider getting some extra income. That will allow you to gradually pay down a lot of your debt and invest at the same time without really compromising your budget. Now, I know you probably have some strong feelings about what I showed you. The numbers need to make sense for you. And if your numbers are not making sense, you got to do what makes sense for your specific, unique situation. You need to consider the pros and cons of both options and take time to understand inflation. It's the silent tax. Very few people understand it. But once you understand it and you're able to leverage your assets in combination with inflation, layer on tax on top of that, you're going to be a master at building wealth using other people's money.